you've been investing in crypto under the impression that it's invisible to the taxman, then you need to listen very carefully to this video. From January 1st, 2026, the rules of the game in the UK officially changed. HMRC now has brand new superpowers for tracking crypto assets that they've never had before. If you're still operating on the assumption that your digital wallet is invisible, then you are now at significant risk. The Cryptoasset Reporting Framework, or CARF, is no longer a future proposal, it's now the current law. I'm Abbas, a chartered accountant and a chartered tax advisor. Today, I'm explaining why the transactions you're making right now are already being logged for an automatic report to HMRC, and what the International Data Sweep of 2027 means for your past and future gains. Since January 1st, every single UK-based crypto exchange and custodial wallet provider has been reclassified as a Reporting Crypto Asset Service Provider, RCASP. That means that they have shifted from being a passive platform designed to help you to being an active reporting agent for the government and for HMRC. Now that means that your Coinbase, Binance or Kraken portfolio, whichever one you use, which was previously a private platform, now has to provide HMRC with all of your info. And they are now legally mandated to collect and verify your full legal identity, verified against your national insurance number or UTR, every relevant transaction. This includes buys, sells, and the one that catches everyone out, crypto to crypto swaps. And third, the total value of your holdings as at the end of the year. Now, this is a massive change. HMRC now has access to your crypto disposals and can cross-check exchange data against your tax returns. And it's not just a UK thing. The UK is leading a first wave of over 50 signatory countries, including the EU, Cayman Islands and Brazil. By May 31st, 2027, HMRC will receive its first massive data dump, covering every transaction that you made in the 2026 calendar year. And if you think moving your assets to an offshore exchange in a place like the British Virgin Islands or Jersey protects you, then think again, because these jurisdictions are also part of the automatic exchange, and HMRC will be able to see your crypto held in these jurisdictions just as clearly as they can in your UK accounts. The HMRC is looking at crypto in much more detail. 2024-25 was the first tax year where there was a dedicated section on the tax return for cryptocurrency. Now, in 2026, they're using sophisticated algorithms to cross-check that section against information that they receive from your exchanges. If there's a mismatch, you won't just get a friendly nudge letter. You could face penalties of £300 for every instance of inaccurate reporting. And if they deem that your behavior was deliberate, they could look back 20 years into your financial history. So what can you do now? Well, carry out an immediate audit. Download all of your transaction history from every exchange that you've touched. And secondly, learn the rules. Because remember, CGT is due on every disposal of a crypto asset, not just when you withdraw it into your bank. A swap of Bitcoin into Solana and then a swap from Solana into Bitcoin counts as a disposal that could be taxable if it was done at a gain. And thirdly, voluntary disclosure. If you do have undeclared gains, don't wait for the 2027 data sweep. Use the HMRC Crypto Asset Disclosure Service now. Voluntarily coming forward generally results in significantly lower penalties compared to being discovered by HMRC's algorithms. So the 2026 rules have turned crypto into a mainstream, fully transparent asset class. But don't let a hidden gain from a couple of years ago sink your financial future today. If you need help structuring a disclosure, reach out. Otherwise, I'll see you in the next video.